This conference will now be recorded.
Hello, today this seminar is going to be about ABLE accounts and when the individual who has a disability and owns the ABLE account is working. This is not designed for somebody whose first question is, what is an ABLE account? Or where do I find an ABLE account? Things of that nature. Those are all addressed in my introduction to ABLE accounts, as well as the ABLE National Resource Center. I'll be doing several other advanced planning some webinars like this where I'm focusing on ABLE accounts. So if you're not worried about the individual working and trying to understand how to incorporate an ABLE account with their job, you can skip this one. So the questions we're going to address in a roundabout way are, should you use an IRA, should you use your employer's plan, downsides of IRAs and employer plan, how much can you contribute to an ABLE? I'm going to touch on these. More of it's going to be focused on, at the end, I have 3 exercises where I want to walk us through some scenarios where you can make a decision of what would you do. And I will walk you through my reasoning for what I would recommend if they were my client. I want to make sure I cover definitions. Taxable money is money that we own taxes on now. Examples of that are savings accounts, your typical brokerage account where you're investing money, things like that. Tax deferred means you're eventually going to owe taxes on it. That's going to be your traditional IRA, your employer sponsored plans, things like that. And then tax free is going to be a Roth IRA, potentially ABLE account. So what are retirement plans? The ABLE account is not a retirement plan. The retirement plans, the ones that are owned by individuals, are traditionally going to be your traditional IRA, your Roth IRA. This is the only tax-free account that you have as a retirement plan. Your simple IRA and your SEP IRA. Simple and SEPs may be offered by employers. If you're self-employed, you may be doing one of these. I'm going to be taking some time to explain what they are in additional slides, because I think it's important to give people a baseline knowledge. If you already know them, you can walk away from the computer for a few minutes, because as I review them, because it's probably going to be more basic than what you're looking for if you're just looking for additional information about what these are. I'm really trying to just provide a very basic introduction. And then your accounts managed by employers. 401ks are typically going to be for-profit companies, and a 403b is typically going to be a non-profit company. So a traditional IRA, it's tax deferred, meaning you will put the money in, you get a tax deduction, you will pay taxes on it when you take the money out of it. You have to start taking money out when you're 72. There's going to be contribution limits. If you're under the age of 50, the maximum you can put in for 2020 is $6,000. If you're over 50, the maximum you can put in is $7,000. And based on how much money you earn per year, you're going to be limited to how much you can contribute to get that tax deduction. With the Roth, it's tax-free distributions, meaning the money that you're putting in, you've already paid taxes on. You are not required to take the money out while you're alive. However, your heirs will be required to take the money out. Same thing with traditional IRA. Contribution limit is going to be the same as the traditional IRA for how much you can put in, and the income limits are going to be different. They're going to be lower than the traditional IRA. If you want to know specifics, you can look them up online, talk to your financial advisor. Andrew Comero is very good at helping people break down should they contribute to an IRA or a retirement account. But there's plenty of other resources that do a deeper dive into these. I'm just trying to introduce you to them so you get an idea what the limits are. The Simple is a savings incentive match plan for employees. It's also tax deferred. It is an IRA. It is a type of individual retirement account. You are required to take money out starting at age 22. Contribution limits, all these contribution limits are for this year, 2020. If you're less than 50, you can put in a maximum of 13,500. If you're older than 50, you can put in a maximum of 16,500. There are some additional rules tied to the simple that I didn't want to get into because this is not a training about retirement plans. Same thing with SEP, the Simplified Employee Pension Plan. This is also an IRA. There are additional rules, but the ones that you need to be worried about is the money's tax deferred. You are required to take the money out starting at 72. Contribution limit is up to 25% of your income, and you can contribute a maximum of $57,000. These are really good tools for self-employed individuals. Now, I don't have a self-employed 401k here. I didn't call that out because this is not a webinar about retirement plans, but your employer-sponsored plans are tax deferred. You may have the Roth option where those are tax-free. You are required to take money out starting at 72. Contribution limits are less than 50, 19,500. You can read the numbers. So that's what your comparison is, and what's typically your options are if you don't have an ABLE account. All of the if you do have an ABLE account, then your distributions are tax-free, the money grows tax-free, assuming that you use the money for qualified disability expenses. You're never required to take the money out. There's no required minimum distributions, nothing like that. The contribution limit is $15,000. However, if you are working, you can put in an additional $12,490 per year. It has to come from you have to be earning that much. So if you're working and you make $6,000 a year, you can only put in a maximum of an additional $6,000. You can't do the full $12,490 if you're not earning it at all. Now, the other caveat to that is you can either contribute the extra $12,490 to the ABLE account, or you can contribute it to a retirement account. You cannot do both. You can, and I want to stress this, you can put $15,000 into the ABLE account and still contribute to a retirement account. So let's use some real examples. Example number one, child lives with mom and dad, no expenses, is working, and I don't have ages in here because I don't really want to focus on teens, adults, or what type of disability. So let's start. Lives with mom and dad, no expenses. Mom and dad are only charging rent. The individual's working 10 hours a week, earns $12 an hour, works out to be ballpark $520 a month, is not getting any benefits from the employer, receives an extra $565 from SSI. So right there, looking at just over $1,000 a month, a little more than $1,000 a month in income, pays mom and dad $400 a month in rent, which they're depositing into the ABLE account. So there's, that's $6,000 a year or $4,800 a year going into the ABLE account from mom and dad. What would you do in this situation? Knowing that the child has no expenses, for purposes of simplicity, there's $1,000 a month coming in, $400 a month going to mom and dad for rent. So 1,000 minus 400, you have $600 left over. It can't go into a savings account because it would run the risk of exceeding the limit in a few short months of the $2,000 asset limit. So what would you do with the $600 extra a month? What I would do is I would be taking that $600 a month, and I would be looking at adding it to the ABLE account. So let's do some math real quick. 600 times 12, $7,200, right? And mom and dad are putting an additional $4,800 in. So the annual contribution is $12,000 a year, well within the $15,000 a year limit. Now, this can adjust if additional expenses come in. If you want to use some of the money for monthly fund expenditures, what have you. But that's what I would be doing. I would be taking the extra $600 a month and be putting it into the ABLE account for the individual. So example 2, lives alone with supports, is works 40 hours a week, earning $22 an hour. So perhaps this individual does not have an intellectual disability. Maybe they have cerebral palsy or another disability where they can work full time. They do not have any Social Security benefits or state supports. They have health insurance with the employer. They're allowed to participate in a 401k with no match. After all expenses are paid, they have $800 remaining, and the family is covering the cost of supports. So that coverage may go away down the road. And the family is gifting $6,000 a year to the ABLE. What would you do? Again, in this case, I would look at probably contributing to the ABLE account, and here's why. So you have $800 a month times you don't have to contribute everything, right? I mean, you can, in this case, you aren't necessarily worried about keeping SSI or Medicaid, but you do have a disability that qualifies you. So, you can do the $9,600 a year. The family is gifting $6,000. So normally that would exceed the $15,000 limit. However, because the individual is working, they can put in the additional $12,490. In this case, it would just be a $600 surplus, and still work. This is assuming they meet all of these are assuming you meet the definition of disability and you qualify for an ABLE account. So I would again put the money into the ABLE account, understanding that at some point that cost of supports may go away, and you may not be able to. So the $6,000 is going to, let's say when mom and dad die, $6,000 goes away, the cost of supports goes away, your expenses go up by $800, for example. But you want to get that money, start saving while you're able to, and make the most of it while you're able to. Now, obviously, we don't know what the real situation is. I'm only trying to provide examples to get you thinking. So example 3, lives alone with supports, works 40 hours a week, earning $14 an hour, works out to be, and I'm rounding on this, works out to be about $2,400 a month, health insurance from the employer. They are allowed to participate in a 401k, and they get a 6% match. Has $300 per month remaining after all expenses are paid. Supports are provided by Medicaid waiver. What would you do? So in this case, because they're on Medicaid, a waiver, I would again probably look at doing a ABLE account. If the supports were not provided by Medicaid waiver, so let's say in this example there was a match, then in this example I would do the 401k instead of the ABLE. In this example, because there is a Medicaid waiver, I would probably look at doing the ABLE account to minimize the exposure to the waiver. But instead, this would be something you'd want to do a deeper dive in. Now, I want to be clear is I haven't done any examples with IRAs because, in my opinion, there is no time where an individual should be using an IRA if they qualify for an ABLE account, because the contribution limit for an ABLE account is $27,000 if you're working, and it comes out tax-free. With a SEP, although you can work and contribute as much as $50,000 a year, I don't think the majority of, so I plan for the majority of people. The majority of individuals and families I work with are not going to be earning enough to put in $57,000 a year of their income into a SEP IRA. They may have opportunities to contribute to a traditional or Roth IRA. However, the ABLE account is much more attractive in both those situations, because if they're working, they can contribute twice as much as they can to a traditional and Roth. And if they're not working, they can have $15,000 put into the account, whereas a traditional and Roth IRA, you have to work. If you want to put $6,000 into a traditional or Roth IRA, you have to earn at least $6,000. So there's no case where I would ever recommend somebody use an IRA instead of an ABLE account. There may be times where I would recommend using a employer-sponsored plan instead of an ABLE account, but it would have to be weighed on an individual basis. ABLE accounts are fantastic tools because of the flexibility that you have when you're taking withdrawals for qualified distributions, as well as the ability to put in an additional $12,000 in some change if you're working. So this is, again, the first installment of advanced planning with ABLE accounts. There will be additional ones coming. I hope it's helpful. If you have specific questions, please feel free to reach out to us. Email is the best way to connect with us. And we are working with clients in all 50 states, and we're happy to hear from you.